Hello everyone. In this video, we'll be talking about long positions versus short positions, and this is part of our course on fundamentals of trading. So here is the outline for the video today. We will begin with basic definitions. Then we will be delving deeper, and we will talk about the key aspects of having a long position in a stock. And in the final part of the video, we'll talk about what does it mean to cover a short position. There are thumbnails in the video description, so if you want to jump ahead to a particular section, please feel free to do so. So let's get started with basic definitions. So what does it mean to have a long position? Essentially, a long position means ownership of a security. This can be a stock, an option contract, a bond, or any other asset, right? Why would we have long positions? Typically because we believe that the asset will gain in value. So it means that we would have a bullish view on that asset. So if I go long on Microsoft stock, that means that I hope that the Microsoft stock will be gaining in value in the coming months or years. And short position is just the mirror image of this. When you are established in a short position, let's say in a stock, essentially you are short selling that stock. So you are borrowing the stock from someone else, from another investor, and you are selling it in the open market, right? And the brokers can facilitate that for you. And why would you do that? You would do that because you believe that the stock that you are borrowing and that you are short selling will lose value. So you will sell it currently at a higher price and hope to buy it back in the future at a lower price. So this signifies a bearish view on the underlying asset. Now that we are equipped with the basic definitions, we can go ahead and delve a little bit deeper. So let's first talk about the key characteristics of owning or having a long position in a stock. And there are three areas that I would like to focus in this case. First of all, you need to understand that when you go long in a stock, this is a cash outflow from your perspective. So if you go long in Tesla shares, you need to pay money to purchase those shares. So at the point of opening that position, there's a cash outlay. Okay? And what does it give you? The ownership comes with two types of rights. You will be entitled to cash flow rights and voting rights. Let's talk about the cash flow rights first. And this includes normally two things in the case of stocks. First, the changes in the price, right? So if Tesla shares increase, right, in value, you will benefit from that. But also Tesla might be paying dividends. So that's the second important cash flow right. So if Tesla is a dividend paying stock, then you will be paid those dividends into your account in regular intervals. So there are two cash flow rights to owning shares of a stock or having when you have a long position. And finally, an important area of focus is your upside and downside potential. So the great thing about a long position is that you have unlimited upside potential. So for example, if you buy a share for $10, if the price doubles to $20 in future, you will get the full benefit. So it's 100% return. If it keeps rising, your return will keep increasing as well. And there's no maximum return or there's no cap to that, right, over time. And another positive thing is that if things go wrong, if the share price starts in value, the most that you can lose is your original investment and nothing more. And this is due to limited liability. So let's say you invested $10,000 in a particular share. Let's assume the shares were $10 when you bought them, but things went bad. The company went bankrupt, which means debt holders have to be paid first. And after paying debt holders, there's nothing left for equity holders. And in such a case, your shares would be worth zero, nothing. And you lose your original investment of $10,000, but nothing more than that. So there's limited downside potential, and that limit is minus 100% return. You can't do worse than that. And we will see in a second that this is not the case for short positions, which are more risky. Okay, so let's actually move on to that, which is the final part of our tutorial today. So we'll talk about short positions in general and also covering short positions in particular. Like in the previous case, there are three areas I'll be focusing on. So first of all, when you open a short position, you will experience a cash inflow because you are borrowing the stock from someone else, you are selling it to the market, so you get the cash from it, right? So that will be an initial payment to your account right away when you open that position. Now, when you are maintaining the position, if the stock pays dividends, you are obliged to transfer them to the original owner because they are the rightful owner of that stock. You borrowed it from them to sell that to the market. And at some point, you need to close that position. So actually covering a short position means closing that position. So when you open the short position, you short sell the stock, but in future you'll need to buy it back at some point, and that means covering that position. And your hope is that if you sell it for $10, you will cover it for less, let's say $8, right? So let me try to illustrate it on the slide here. So let's say you get $10 when you open the position. If you manage to sell it for 8, right? So this is a cash inflow, what you get. This is what you pay to buy the stock back. Your profit per share is $2. And this is if things go according to your expectation. So this is what you are trying to do. You go short and you hope that the price will go down at some point. And when that happens, you will try to cover your position. And like I said, you need to pay dividends if they sort of arrive at this point. But things may actually go wrong, right? And against your expectations. Let's suppose again you buy it for 10, but let's say that you observe that the share price then increases to 12. Now, if you close your position at this point, this will be a $2 loss per share. You might say that, okay, I still believe in my bearish view and believe that the stock will lose value, so you can keep the position open. But what happens if the stock price keeps increasing, right? Your losses would be unlimited. So in this case, you bought it for 10. If you close it for $40, that's a loss of $30, which is worse than minus 100%, right? Because originally you get $10. Now you need to pay back at $40, yielding a loss of $30. So that's why we say the short position has an unlimited downside potential. So as you can see that there's high levels of risk involved here. And what would happen in reality is that if this starts to happen, your broker will ask you to post margin, which means that the broker will urge you, to put cash into your account to start covering this position, right? Otherwise, your losses will become infinitely high. So you'll start covering your position if the price starts to go in the wrong direction. All right. So let's summarize our discussion with this nice table over here. So there are two fundamental types of positions when you invest in assets. You can take a long position, in which case you are hoping that the value of the underlying asset will go up, right? At the point of opening, this will be a cash outflow because you need to pay to acquire the asset. And you will make a profit if your view turns out to be right and the asset gains in value, okay? Or you will make a loss if the asset value comes down, right? And we have the mirror image of a short position where you are betting that the value of the underlying asset will go down. At the point of opening this position, this is a cash inflow, right? So you will get money when you open the position. But at some point, you will have to close it and return the asset to the original owner. And at that point, you can make a profit if you manage to buy back the asset at a lower value, or you would incur a loss if you have to buy it back at a higher value. All right, that's all from me for today. I hope you found the video useful. If you liked the video, please consider liking it and subscribing to our channel. And I look forward to seeing you in another video. Thank you very much.